Welcome to this edition of Diligence Inside America's Boardrooms. I'm TK Kerstetter, and I'll be your host for today's show. Today, we're going to talk about what boards can expect this proxy season. And joining me is Paul DeNicola, who's a principal with PwC's Governance Insight Center. Paul, welcome back.
Thanks so much for having me again, TK.
So we want to look at the developments that are potentially impacting boards during the 2021 proxy season. And I thought a good place maybe for us to start was shareholder meetings. And my general question is, are we going to still be in the virtual mode like we were in 2020, or will there be somewhat of a change this year?
Yeah, so if you think back to 2020, the 2020 season came around really as the first wave of the COVID-19 pandemic was reaching its apex. But interestingly, companies had been testing this idea of virtual shareholder meetings before. You had close to 10% of the Russell 3000 that was already doing virtual meetings. Obviously, due to COVID, the number of virtual meetings in the S&P 500 surged to about 80% last year. In my view, for 2021, most companies, though not all companies, are planning to conduct their shareholder meetings in a virtual way. But I think that there are many lessons that can be learned from the experience of last year that can be integrated into the 2021 meetings. I think first and foremost, companies are going to ensure that any technical or administrative issues that arose last year have been addressed. And then many companies have also proactively engaged with institutional investors to highlight the measures that the company has taken and adopted to be able to better facilitate the virtual meeting experience. And that's particularly true when it comes to the Q&A session, which was a cause of consternation for many investors in 2020.
Yeah, I know that that was sort of the stumbling block when they could only get to 10% in previous years, but with the advent of the pandemic, it really made quantum leaps in the virtual board meetings. So I suspect that it's going to continue, but I wouldn't be also surprised if some companies come up with some kind of hybrid as these vaccinations keep going. But I think,
I would say that companies should be mindful of the fact that there was an opposition to virtual only annual meetings prior to COVID on the part of some investors and the proxy advisory firms. That could resurface post-pandemic, which might have implications on that. I think we will not go back to where we were. In the new normal, it will be probably some combination of virtual and hybrid.
Yep, just like board meetings. So what other proxy season issues should boards be sensitive to as you look into this topic?
One thing that I always tell our clients is that they really have to pay attention to the changes in the proxy voting policies of their largest investors. So there were substantial changes to some of these policies for 2021. Take BlackRock, for instance. BlackRock signaled that it had an increased willingness to vote against companies when it came to shareholder proposals or to vote against directors. And there were some key changes to the policies there. One is that they heightened their attention to board ethnic and gender diversity, including expecting disclosure of diversity characteristics. Another change was around board tenure. So this idea of a mix between new directors, those with medium tenure, and those who are long serving. BlackRock will be looking at that tenure mix more closely. They also expect companies to disclose plans for how their business model is compatible with a low carbon economy. And finally, I think there's going to be greater support on their part for corporate political spending disclosure shareholder proposals. So that's one example. State Street, another large institutional investor, has announced that in 2021, they're going to vote against the chair of the Nominating and Governance Committee at companies in the S&P 500 that don't disclose the gender, racial, and ethnic composition of their boards. And State Street already has announced policy changes for next proxy season for 2022, where they say they're going to vote against the comp committee chair at S&P 500 companies that don't disclose the EEO1 diversity data, and against nom and gov committee chairs at S&P 500 companies that don't have at least one director from an underrepresented community. So I'd say the big takeaway is make sure that you're monitoring these changes in voting policies at your largest investors.
It's been a transition to see these institutional investors becoming more active to the point of withholding votes, on directors. But there's also out there plenty of other investors that are, if you will, active. So what are we going to see in the way of shareholder proposals for 2021 that maybe boards should be thinking and preparing for?
Yeah, as you'd probably expect, shareholder proposals related to a number of ESG related topics are going to dominate the 2021 season, as they have for the last several. I think they fall into a few buckets or categories. One would be around climate change. So climate change clearly is a prominent issues facing investors and companies in recent years. But investors have traditionally targeted companies with the greatest exposure to climate risks, such as energy companies or those in the other extractive industries. But what we're starting to see now is that the focus includes companies outside of those industries. And so these companies are being asked increasingly to provide enhanced disclosure in shareholder proposals concerning their climate impact and risks. And we anticipate strong shareholder support for these climate change related proposals. A second big bucket, I'd say, relates to human capital management. So, human capital management touches a wide range of issues, from employee engagement to prevention of sexual harassment to diversity and pay equity. And in the last few years, investors have been pushing companies for more information on how they're managing human capital. And the focus on human capital management really only intensified this year with both the pandemic and the racial justice movement, placing a real spotlight on companies' approach to diversity, equity, and inclusion. So as far as shareholder proposals, this year that trend continues, with shareholders pressing companies to provide additional disclosure again concerning their DE&I commitments and other steps that they're taking to ensure inclusive working environments. And the last big bucket, I would say, TK, is continuing around board diversity. So, regarding board diversity, many institutional investors have adopted proxy voting policies over the last several years aimed at promoting more gender diversity on boards. Now, focus from investors has grown to include racial and ethnic board representation and diversity among senior executives. So shareholders are increasingly calling on companies to, again, provide more disclosure on how they're promoting not only women, but ethnic minorities and racial minorities within their organizations, and the consideration that boards have when appointing new directors.
Paul, do you see any change in the traditional voting trends on pay because of the pandemic? Do you anticipate that, companies have done fairly well, in that thing? Do you see any change with that this year?
I think, the overall paradigm of wanting pay for performance is obviously going to continue. And I think investors are looking at the issue of discretion probably the most closely, right? In terms of wanting to ensure that you balance being able to reward executives and employees who have worked really hard during a pandemic, but at the same time, not sacrificing that from a long-term perspective. So I think there will be an increased focus on compensation committees' use of discretion, but I think that shareholders understand the framework in which companies were working.
It is quite a little dilemma, though, for the comp committees to accomplish both of those things in one fell swoop. But I'm glad that shareholders and the investors are giving comp committees some discretion, to do that. Because there was a time a couple of years ago where they wanted them to have no discretion.
Yeah.
So, well, listen, thanks for taking the time. It'll be fun to watch what comes out of ultimately of some of the votes and some of the shareholder proposals, but we'll keep tabs on that. And I want to thank you for taking the time to get our audience up to date.
Thanks a lot for having me.
And that will conclude this edition of Inside America's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take another look at a critical topic that'll help you be a better board member or committee member. So we'll see you then.